Okay, for more on this UK news and what it means for markets on both sides of the Atlantic, I want to bring in Peter Oppenheimer. He's Chief Global Equity Strategist at Goldman Sachs. Peter, we're dealing with this. We're thinking, I think, a lot about what's happening just with the banks and the earnings we saw this morning, and then this whipsaw just yesterday, and what the Fed may or may not do about all of it when it comes to CPI data. So where are you? Where do you want to start?
Well, I think that, in a sense, what's happened in the UK is reflective of what's happening more broadly, and that is that the cost of funding debt is rising on the back of still rising inflationary pressures, and also, particularly across Europe, the pressures to increase fiscal support to moderate the shock coming from things like real income squeeze as energy prices rise. So, in a sense, it's a broad picture of still rising interest rates. And I think that until there's clear evidence that inflationary pressures are coming down and inflation expectations are stabilizing, it's really going to be interest rates which are dominating the risk backdrop. And certainly, looking back in the past, it's not really been until inflation and rates have peaked that equities have tended to trough in a bear market.
So do you consider what happened yesterday and what we're seeing this morning, at least in U.S. equities ahead of the market open, to be sort of a rally in a bear market? Is that the way to think about this?
I think so, yes. I mean, look, we've seen most equity markets falling well into bear market territory. 25% broadly is what most have done, at least in local currency terms. Of course, in dollar terms, many markets outside of the US have done a lot worse. But typically, we see equities falling around 30% in bear markets that are associated with rising interest rates and recessions. So I think we're quite far through this, but I don't think we've yet seen the conditions that would typically be consistent with a final trough. So I think this is just a rally in that process. We saw a strong rally, of course, remember, in the summer on what was then quite premature hopes that interest rates had peaked or were quite close to it.
Okay, so I think in your estimation, though, the downside risk from here in the equities markets, and by the way, there were a lot of traders yesterday who said, oh, the S&P 500 was just oversold, and so it's just, given where volatility was, given where everything else was, that's why we've seen this little rally. But you look at it, and are you in the Jamie Dimon camp that things could get as bad as another 20% or not? And then what's the upside? By the way, not to say what the upside risk, but what's the upside at this point in the game?
To the first point, no, I don't think the scale of the likely declines from here would be so significant. And there's a couple of important reasons for this. One of them is that in the periods where in the past you've seen really dramatic falls, 50 or 60%, as we did in the financial crisis, these have really been associated with systemic crises as interest rates have risen and asset markets have deflated. And they've reflected very weak private sector balances, particularly in the banks. We don't have that now. We've got strong private sector balances.
Is there any chance that this is going to be we're going to look back and this is going to be an inflection point?
I think it's still too early because I think we need to get more confidence that rates have peaked. I think we also need to get to a point where the rate of macroeconomic slowdown is moderating. Okay. And I think we need better valuation still.
And it's happening going out on the highs.
Not yet.